Good afternoon, everyone. Welcome to the NSE Knowledge Builder series. Once again, it has been NSE's privilege in hosting this Knowledge Builder series where we inform investors about various instruments which are available in the Indian capital markets. So I, Paritosh Dere, on behalf of NSE, welcome you to this Knowledge Builder series once again. Today, we have Ms. Shaili Ved and Mr. Krish Haria from BondsIndia team, who will be basically decoding the bond markets in India for us. And they will cover the basics of investing in bond markets in India and what are the different instruments available in the bond markets in India. So they will basically cover all the details that you would like to know about investing in bond markets and how you can invest, which are the government bonds which are available, the private bonds. So without wasting any further time, I will hand over the session to the BondsIndia team, where they will take you through this session and increase your knowledge about the bond markets in India. So over to you, Shaili and Krish.
Thank you, Paritosh, for the introduction. Thank you, NSE, for giving us this platform to discuss the contours of the bond market. Very good evening to the audience here. It's our endeavor to make this session informative, and we hope we are able to discuss the important aspects of the bond market. I'm Shaili Ved, and I handle the trade desk at BondsIndia. I have close to 10 years of experience in equities and debt market. Today, I'm joined by my colleague, Krish Haria, and he has around 3 years of experience in financial markets. He handles the SLR desk here.
Very good evening to everybody, and a very warm welcome to all the attendees today who have attended our webinar today.
We'll quickly give a brief about our company.
Yes.
So BondsIndia is a new age fintech startup with company founders having a combined experience of over 30 years in bond market. It is country's first online fixed income portal whose primary focus remains to simplify the bond markets for retail investors, alongside educating and advising them at each step. So it's the only platform having real-time online trade settlement facility, and we have a total base of close to 1 lakh clients. So today I believe that a large number of audience present here have attended our earlier webinar on do's and don'ts of investing in bonds market. And through the next 1 hour, we intend to decode the bond market and share important nuances of bonds. So we'll start with decoding the bond market. To begin with, let us understand the financial market structure first. So a financial market is a place where buyers and sellers come together to trade in financial assets like bonds, stocks, currencies, commodities, etc. So though the financial market has various components, there are two most important components, which are the money market and the capital market. Now, in the money market, only short-term liquid instruments are exchanged. Here, the instruments mature within 1 year. Some of the important money market instruments in India are commercial papers, certificates of deposits, treasury bills, etc. Now, coming to capital markets consist of equity and debt, and bonds fall under the debt segment. Bonds are issued in primary markets and they are traded in secondary markets. Now, during the bond issuance, the bond issue will have a minimum issue size or a issue quantum, which is known as a base issue. And the additional quantum to be issued is also known as a green shoe option. For example, if the issuer, say an issuer ABC will have a base issue size of 100 crores and the green shoe option of 500 crores. So that will make the maximum total quantum of the issuance of 600 crores. So trading typically in bond market happens through either online portals or OTC, which is over the counter. Now, the clearing houses are ICCL and NSCL. So ICCL is Indian Clearing Corporation Limited and NSCL is NSE Clearing Limited. Now, they are being responsible for clearing and settlements of all the trades which are executed, along with the deposits, the collateral, and the risk management functions. Let's have a glance at the Indian debt market. So this is the Indian debt market composition. the segments are broadly classified into GSEC segment, that is the government securities, and the corporate segment. Now, under the GSEC segment, the bond issuer is a sovereign issuer, that is both central and the state government. And public sector undertakings or private sector undertakings, they fall under the corporate segment. Now, coming to the central and the state government, the central government issues the GSEC and treasury bills, and the state government issues the state development loans. And all these three issuances are sovereign rated. And the instruments which are issued by the private sector and the public sector companies are commercial papers, certificate of deposits, or NCDs, which are non-convertible bonds.
So let's take one more poll regarding the 2 slides that we've covered.
Yeah, Ankita, can we request you to conduct the second poll? Which of the following is considered as money market instrument? The instrument which is 1 year or more than 1 year, 1 year or less than 1 year, 2 years or less.
80% of you all have got the question right. And I think 20% of you all have got it wrong, which is a good sign.
That's a good ratio. So moving on. So the most important stakeholders in the bond market are our regulators, which is SEBI and RBI. So when we say SEBI, SEBI is Securities and Exchange Board of India. And SEBI is the regulatory authority to protect the interests of the customers, of the investors, and is responsible for all the trades in the secondary market. And Reserve Bank of India, or you say RBI, it manages the public debt on behalf of the central and the state government, like the issues which we mentioned in the earlier slides, GSEC, SDL, T-bills, and state development loans. So who issues the bond? So we did cover the broad issuer categories in our previous slide. In addition to the government and government entities, private sector entities holds a lion's share in the bond issuances in India. Now, within private sector, private banks, NBFCs, corporates are hugely active in the bond issuance. Like say in corporates, we have L&T, HDFC Limited. Under the private sector banks, we have banks like ICICI Bank, Kotak Bank, HDFC Bank. And under NBFCs, we have companies like Ugro or maybe Navi Finserv. And in the government sector, we have sovereign bonds, sovereign rated bonds. Under that, we have GSEC, T-bills as mentioned earlier. And then under state government guaranteed bonds, we have papers like UP Power, AP Andhra Pradesh, State Beverages, etc. And then we have state development loans. We have public sector undertakings where we have bonds like REC, PFC, NABARD. These are all the PSU bonds. And under public sector banks, we have many banks like SBI, Central Bank, etc. We can have one more poll over here. So which of the following does not come under the private sector issuance? Corporate bonds, NBFCs, or PSUs?
75% of you all have got it right that PSUs do not come under the private sector issuance. They are a public sector issuance.
So let's understand who participates in the bond market. So the broad categories are the non-institutional investors, institutional investors, and the corporates. So the non-institutional investors are retails, HNIs, and family offices. And institutional investors can be mutual funds, pension funds, that they can be insurance companies. And corporates, see, the most of the treasury investments of the large and medium-sized corporates are made towards fixed income or the bond instruments. So these are the categorized under the one of the major participants in the bond market. Now, why did bond get introduced after all? So bonds, first of all, it helps in raising large funds to meet the business needs. When we say this, we say, for example, let's take example of a textile trader. Say there's a textile trader in Surat who could take a bank loan funding or could raise debt through bond issuance to expand his existing business. So he may not have to rely on his self funds to grow the business. And it's an alternative to the traditional financing source also. Over here, borrowings can be done effectively through bond route in addition to the bank borrowings. So earlier people would have borrowings from the bank, but now additionally they can have borrowings to the bond route as well. Now borrowing cost is also a bit relatively cheaper compared to the raising equity, and there is no dilution of equity in the company. So when we say this, debt issuance ensures that the promoter is not required to bring in any additional equity or is not needed to dilute his own stake in the equity. Bonds, aakhir kya hote hai? So we've given what we covered in the previous slides. We have a little idea about what are bonds. Now we'll take you in detail about some characteristics of the bonds and what exactly are bonds. So bonds are basically the debt instruments which are issued by a corporate or a government or government undertaking, and they are subscribed by an investor at a predetermined time frame and an interest rate. To simplify it further, bonds are the securities where an investor, who is also known as a debt holder or say a lender, would lend money to a company, a corporate or a government on a predetermined terms for a set period of time in exchange for regular interest payments. Now, let us understand what is a principal amount. So, principal, coupon, interest, maturity. Most of us over here must have heard about these common terms. So, principal amount is the original amount of investment which the investor receives at the end of the maturity, at the maturity of the bond. So, it also refers to the face value of the bond. Now, it is the amount which the issuer agrees to pay to the investor when the bond expires. And what is interest or coupon? So interest on the bond is a return which is expected from the bond on the principal investment. So whatever the principal amount you're investing, the coupon or the interest which you expect from that is known as the interest rate or the coupon. Now, maturity is when the bond expires. So this is when you are paid back the principal amount along with the interest. Now, interest is basically nothing but the coupon of the bond. So it is the percentage of the principal which is paid back to the investor as interest. Coupon can be monthly, semi-annually, quarterly, annually. It totally depends what you would select for. Go in for which coupon upon your risk appetite, your goals, why do you want to invest. Say for example, if the coupon is 10% and the principal amount is 10 lakhs, and it's a 3-year paper. Having said that, that means the maturity is after 3 years. So for an annual interest repayment paper, you will receive 10% of 10 lakhs. That is 1 lakh in the first year, 1 lakh in the second year, and in the third year, that is when the bond would mature, you will receive the principal amount plus the interest of that particular year. So you will receive 10 lakhs of the principal amount which you had invested and 1 lakh interest on it. So total for that year, you will receive 11 lakhs of maturity.
So to add further on these points, I would also like to expand by saying that why are bonds stable investment options? So let me just start by saying that why do retail investors think that investing in the fixed income market is a stable choice? First of all, it's because of the fixed coupon rate. Now, it's basically a fixed rate which is attached to the bond. It is an annual income that an investor can expect to receive if he's holding that particular bond. It is fixed in nature and it is mentioned in the term sheet before the issuance. Coming to that, regular interest payments, now depending on the coupon rate, there is also a fixed frequency of interest payments that is mentioned in the term sheet. Bringing us to our second point, which is regular interest payments. Like Shaili mentioned earlier, there are different kinds of frequency of interest payments like monthly, quarterly, semi-annually, or annually. The maturity date defines the lifespan of a security, which informs the investors of when they will receive their principal amount and their final interest payment. And also the maturity date is the date after which the bond ceases to exist. I'm going to take you through some of the factors which affect the bond market. Now, there are a lot of factors which shape and influence and control the bond market, but we're going to look at 3 factors right now. One of them is change in interest rate. Second is inflation rate and inflation expectations. Third is the trade deficit and debt. We're going to go in detail regarding the first point, which is change in interest rate. Now, change in interest rate, like first thing I want to explain to everybody is that a bond price and the interest rate have an inverse relationship. Now, what does that mean? So whenever a company who wants to raise money, whenever it's a rising interest rate scenario, the prices of that particular bond will always fall. For example, most of the bonds that pay a fixed interest rate that become more attractive if the interest rates are falling, because when the earlier coupon rate is already fixed at a higher interest rate, that bond becomes more valuable and the demand for that bond rises, inherently rising the price of that bond. Conversely, if the interest rate rises, and in a rising interest rate scenario, investors will no longer prefer the lower fixed interest coupon that they have blocked earlier, because in a rising interest rate scenario, the fixed coupon rate would be lower afterwards, resulting in a decline in its price. Let's move on to our second point, which is inflation rate and inflation expectations. Let me just start by saying that inflation is a bond's worst enemy. Inflation basically erodes the purchasing power of the future cash flows that the bond is going to receive to the investor. For example, whenever there is a higher inflation scenario, you always calculate a real return. Now, what is a real return? Real return is nothing but a return that is adjusted for inflation and taxes. I'll give you an example. If a bond investor, if he purchases a bond at 8% yield and the inflation rises up to 6%, the real return for that investor would actually be 2%. So consider purchasing an 8% 10-year high-yielding corporate bond before inflation hits the market. 4 years down the line, when inflation has hit the market, the same issuer takes out an identical bond, but with a higher interest rate, so for example, 10%. So the bond which he had earlier issued at 8% is no more as valuable after this issuance, because it's an inflated market, and in an inflated market, people would expect higher returns. The third point is trade deficit and debt. Let me explain to you guys what a trade deficit is. Trade deficit is nothing but a situation in which the value of goods a country imports is greater than the value of goods than a country exports. So there is a positive correlation between trade deficit and debt in the country. So if there is a lower trade deficit, for example, that means that the exports of the country are higher. Now, if the exports of the country are higher, that means more foreign currency is coming into the country. When more foreign currency comes into the country, it is going to get invested in different asset classes. One of the primary asset classes being debt market, where people invest in bonds. We could also say that when the trade deficit is lower, people feel richer in the country, because due to higher exports, there is higher generation of income. And because of that higher generation of income, they might debt market or different asset classes.
So these are one of the most common terms, or you can say these most known terms which are used in the bond market. Issuer, all of us know now who the issuer is. Issuer can be any company or the government agency who issues a bond. Information memorandum. So information memorandum, it's a very informative document which is prepared by the company to provide a comprehensive overview of its business, which is referred by the prospective investors. So a coupon. Coupon is the interest rate which is payable on the bond, clean price and dirty price. So most bonds are all traded at clean price. It is the price of a coupon bond, which doesn't include any accrued interest. Now, what is accrued interest? Accrued interest on a bond is the amount of interest that is accumulated on a bond since the last coupon payment. So the interest has been earned, but because the coupons are only paid periodically at set intervals, the investor has not gained the money yet. For example, just let us take an annual frequency. Yeah, so annual frequency interest payment on the bond. The interest is say paid in August. Now, as of now, we are at December. So the interest is accrued from August to December, but it is not paid. So the dirty price is the price of a bond that includes the accrued interest between the two interest payments. Yield is the overall returns that we earn on the bond. Callable bond. This is the issuer has an option to repay the bond before the scheduled maturity. Like a 5-year bond, a bond having a 5-year bond can be redeemed at the end of 3 years at the option of the investor. So when a bond is traded during the shut period, the security is transferred to the receiver, but the upcoming interest payment would be paid to the original bondholder. Now, the receiver has to receive the X interest. Credit rating, credit rating is the assessment of the credit worthiness of the issuer of the bond. We'll cover the credit rating in detail in the subsequent slide. Debenture trustee. Debenture trustee is a SEBI regulated entity whose role is to protect the interest of the investors. Cash flows are basically, they're prepared for the investor to know that when he or she would be receiving their interest payments and what yield or the total return would be expected at maturity. Ankita, can we request you to conduct a poll here?
Do you know? So interest rate on a 5-year FD with SBI Bank is lower than a 5-year AA plus rated SBI bond. 95% of you all have got it right by saying that the interest rate on a 5-year FD with SBI Bank is lower than a 5-year AA plus rated SBI bond.
So what does a credit rating tell you about a bond issuer? So this is the most critical consideration in bond investing. Credit rating is an important assessment of the credit worthiness of the issuer. Some of the SEBI registered credit rating agencies are CRISIL, ICRA, CARE, India Ratings, Acuity, etc. Now, as we can see here, there's credit ratings go on from AAA, AA, A plus, BBB, BBB, C, D, and so on. So AAA is the highest rating category, while C being the lowest rating category. And ratings between AAA and BBB are investment grade ratings, while ratings of BB and below are considered to be speculative grade ratings. So if an investor wants to invest in a bond and would not like to take any risk and is looking for the highest degree of safety, he would go in for the AAA rated bond. And if somebody is willing to go on for a very high yielding bond, can go in for a BBB rated bond, which has a moderate degree of safety and moderate credit risk, but will give you higher yields.
Ankita, we can conduct one more poll. What are the possible apprehensions you have about investments in the bond market? First, that it has low returns. Second, lack of understanding or any professional help. Third, you are unaware of the investment process while investing in the bond market. And fourth is the combination of all. So the results that we can see over here, that 60% of y'all have ticked on the box combination of all, where most of y'all are unaware of the investment process and have a lack of understanding of the debt market and the fixed income market. We can move on to the next slide.
Yeah, you can actually reach out to your broker or a relationship manager, and they would definitely help you assist in the investment process and understanding of the bond market. So how many choices are there in bonds? So there are various types of bonds available, and an investor can invest in the bonds as per their risk appetite and their goals for investing. So for someone who would want to take higher risk, can go in for high yielding bonds. Then there are state guaranteed bonds, bank bonds, PSU bonds, GSEC. There are SDLs, state development bonds. Anybody falling in a higher tax brackets can go on for tax-free bonds. Then there are structured bonds like MLDs. There are perpetual bonds. So there are multiple options wherein you can invest. That totally depends upon your goals, your objectives of investing. This would also depend on your age, your income, the capital earned, and the risk appetite that you would have. So these are the must know features of a particular bond. Now fixed and floating. So the interest rate can be either fixed or floating. Interest rate can be fixed, that means that it will not change in the life of the bond. Now, floating rate bonds are linked to some benchmark like GSEC, or change in repo rate, interest rate would affect it. Secured and unsecured. Now, bonds can be secured, backed by future payments from the debtors and company assets. And unsecured bonds are generally not backed with any security or any company assets. Rated and unrated. The bonds are rated by a rating agency on rating scale, which we just discussed in our previous slide, which is from AAA, AA plus, minus, A plus, BBB, and so on. And unrated bonds, they do not carry any credit rating. Rated bonds are mostly preferred among investors since they carry a detailed credit assessment of the issuer. Now, listed and unlisted bonds. So bonds can be listed on exchanges. Perpetual bonds. So perpetual bonds, they do not have any maturity. They carry a call and a put option to be exercised by the issuer. Market-linked bonds. So they are known as MLDs, that is market-linked debentures, where the returns are not fixed, but they are linked to an underlying security or an underlying index. Now, tax-saving or tax-free bonds. So tax-free bonds are those fixed income securities which are issued by the government, which offers tax-free interest on the income which is earned by the investors. Now, the investors earn fixed interest, or you can say a pre-fixed interest each year without incurring any tax obligations on it. And just like every other bond, principal amount is repaid on maturity. Now, seniority. So, see, the bonds are categorized under as senior bonds, as senior secured bonds, subordinate, unsecured, super senior bonds. Now, with respect to a company's capital structure, seniority refers to the order of the repayment to the bond holders in case if there is any default on the issuer's front. So now a senior secured bond, it will hold a greater degree of safety compared to the other bonds in the security hierarchy. So it will offer, and because of the highest amount of safety that it offers, it will have a lower yield comparatively.
So I'm going to explain you the two routes for bond issuances. So companies raise debt for investors either in the form of a bond IPO, which is a public issue, or they raise debt in the form of a private placement. Now, these private placements, usually, they are for large institutional investors. The timings and the details of these issuances are generally not known to the retail investors. Also, for private placements, there are a lot of restrictions that have been put in place by SEBI. So a couple of them being, one, there are a number of private placements in a year that a issuer can do, and it cannot exceed that number. Second, there is a high minimum investment amount for every private placement, and hence it's generally only a big boys only investment option. I'll explain you what a debt public issue is. Now, debt public issues are basically done to attract individual investors, and you can derive a lot of additional benefits for retail clients. Some of the features of debt public issues are that they have a low minimum investment amount. Now, when an investor goes on to purchase a bond during its IPO, that is during its bond IPO, that time the minimum investment amount for a retail investor is 10,000 rupees. There are a lot of additional disclosures which are required by SEBI, and hence it takes full care of the investor's interests. Third, usually all the public IPOs are listed on either BSE or either NSE. There is also complete transparent pricing, as there is a fair price for every investor who takes part in the bond IPO. Differences between public issue and private issue, as I mentioned over here, is that public issue is meant for the general public, and private issue is usually given preference to the institutional investors. Public issues are listed, whereas private issues can either be listed or unlisted. And the public issues are generally for the retail clients, but institutional clients also take part in it. But the private issue is only mainly for the institutional investors. Here I will explain to you why a person should invest in the bond market. Now, first, the point is safety. Every bond that is issued in the secondary market has a credit rating. According to the risk appetite of the investor can decide whether he wants to invest in a bond which is rated AAA all the way down to investment gradable bonds, which comes to BBB. All the bonds have a predetermined return. What do I mean by that? A predetermined return is basically a fixed coupon that a bond has attached to every issue. Whenever a bond has a fixed coupon rate attached to every issue, the investor knows exactly when he's going to receive the interest payment and what is the yield that he's going to get at maturity if he holds the bond till maturity. There is stability in these interest payments because these interest payment frequencies are fixed. Now, it's either quarterly, semi-annually, annually, or monthly, and there is no change in that. And hence there is stability in the frequency of interest payments that an investor receives. Bonds are pretty simple to understand. A bond is basically just a loan that a company is taking, and instead of going to the bank, the company is coming to retail investors and they are raising money for their business operations. There is also diversification in investments if you invest in the debt market, as different asset classes are volatile at different points of time. Whereas if you want a steady and stable fixed return income throughout the year, you should invest in bonds. People also invest in bonds to meet their short-term, mid-term, or long-term goals, depending on their future planning. For example, if they want to meet their short-term goals, like they want to they want to go on a vacation, they can invest in short-term papers close to 3 to 5 years. If they want to invest in a mid-term, if they have a mid-term goal in mind, for example, if they want to purchase a car, they can invest in papers up to 10 years. And if they have a long-term goal, for example, if they want to invest for their children's future education, they can invest in papers more than 12 to 15 years. So that was it for us regarding the presentations. We are going to open up for a Q&A session.
So I'll just stop sharing the presentation here. We'll take up the questions from the live audience. Mr. Sachin Kumar SK from Bangalore is asking, what are the main advantages of investing in bonds or bond market? So, sir, see, there's appropriate risk return on the investments, and investing in bonds is comparatively a safer option in comparison to equity. Also in bonds, you'll get higher returns as compared to the bank FDs. Mr. Nishant Bantia from Mettupalayam is asking, how to find right bonds according to our financial goals?
Okay. So as I said earlier, like there are certain criteria that an investor should look at before he starts investing in the bond market. Now, what is his risk appetite? If he's a risk averse investor, he should look at higher rated bonds like AAA or AA. If he's a risk taking investor, he might take a little bit of risk and take a bond which is yielding a much higher returns, but is not as safe as a AAA rated bond.
So this is from Mr. Harin Dave from Vadodara, and he's asking what should be the bare minimum safety criteria for selection of bonds if AAA or AA rating is not available for the instrument, and which is a better rating agency, CRISIL or CARE. Sir, as explained in our earlier rating slide, the credit ratings are on a scale of AAA to D, D being the rating for the default company, and ratings above BBB, they're considered to be the investment grade ratings, which carry minimum default risk. So the ratings are BBB, BBB plus, BBB minus A, and all the ratings which are these are the ratings which are in the investment grade. And if you're asking which agency is better, CRISIL or CARE, so both CRISIL and CARE are SEBI registered rating agencies, and these both can be considered by an investor, by you, for investing in bonds. This is asked by Mr. Amit Prakash from Noida, and he's asking how to evaluate the bonds of different issuers having different credit rating, and even in one category, say AAA yields are not the same.
Okay. So basically, I think what he means to say is that he's asking me whether all the AAA rated bonds, why do not they have a similar yield?
Correct.
Now let's take examples of two different companies. First, we can take an example of a company like REC, which is a PSU, and we can take an example of a Bajaj, which is a NBFC, for example. Now, both of their works are completely different, but their financial core is extremely strong. They have completely financially sound, and their financials are extremely strong, which makes them a AAA company. But the risk appetite that both of these companies individually run is completely different. And hence, for an NBFC, you might find slightly higher yields than a PSU public sector undertaking.
Ms. Nivedita from Chennai is asking how to calculate yield of bonds traded in secondary market and how to know the shut period of the bond. Krish, you'll take this up?
Yes. So usually on the secondary market, a lot of people do not know this, but on the secondary market, whenever the any bond that is being traded on the secondary market is traded at the dirty price. So if you want to calculate any yield that is traded on the secondary market, you have to calculate it through the dirty price and not the clean price. The clean price is usually used in the primary market. The second question being, how to know the shut period of a bond? Usually the shut period of every particular bond is 15 days before the interest payment. But to know the exact shut period and to not go wrong on this, you should always check the IM of the issue, and the shut period of the bond is always mentioned.
Mr. Mayur Ingle from Akola is asking how to trade in secondary bond market and best short-term bond options available. So secondary market is where the issuer is not needed. So basically the buyer and the seller can freely trade in bonds in secondary market. It is mandatory to have a demat account to buy bonds. And you can actually register yourself with any SEBI registered broker. It's a very simple process. You can either go on online platforms that trade in bonds, and your relationship manager can guide you in the KYC process, wherein very basic documents like your PAN card, Aadhaar card, bank proof, and CML are needed. And so once submitted, there's a user ID and password would be generated, and you can choose which bond you want to buy as per your requirements and the risk appetite. And to sell the bonds which you are already holding, again, your broker will guide you how to go about the settlement. But here to sell, you would need a DIS, which is a delivery instruction slip to sell the bonds in the secondary market. Sonam Bhardwaj from Billai is asking, what are tax-free bonds? So we've covered it in our earlier slides. I'll just again give you a quick brief on it. So tax-free bonds are those fixed income securities which are issued by the government, which offers tax-free interest income to the investors. Now, the investors can earn fixed interest or a predetermined interest every year without incurring any tax obligations on it. And as we discussed earlier, like any other bond, in tax-free bonds also, at maturity, the principal amount would be repaid. So DV Siva from Pedapuram is asking, what is the bond difference with bond and fixed deposit?
Okay.
Bond, yeah. So basically, he wants to know the difference between bonds and fixed deposits.
So let's compare. So for example, if you want to know the difference between a fixed deposit and a bond, let's compare both of them over here. We can take an SBI FD and we can take a SBI 5-year bond, which is AA plus rated, which are similar companies. Both of them, the same company offers an FD and the same company offers you a bond. Now, whenever you invest in a fixed deposit, it usually pays you a cumulative interest, and the complete interest is paid to you at maturity. Usually when a bond matures, you have to pay 10% TDS upfront, and after maturity, according to your tax bracket, you have to pay 30% of your total interest. When it comes to a bond, you are usually given a fixed coupon rate with fixed interest payments lined up. Usually bonds have higher interest rates than FDs, and they are equally as safe depending on the credit rating of the bond. And if we are comparing the similar company, it is the same thing. Also, at maturity, you will not have to pay any upfront TDS like you had to pay in your fixed deposit, which is 10%. And if any losses, you can book those losses as well.
This bond, just 1 second. So this is Mr. Karthik Murugan from Navali asking, does bond interest rate change every day? And does the bond, can the bond be liquidated as and when required like shares? Okay. So the bond coupon can change based on the change in benchmark of the bond for a floating rate bond. However, most bonds have a fixed coupon rate, and yield and price of the bond can change on external factors as highlighted by Krish in his earlier slides, like for change, like if there is a change in interest rate, inflation, trade deficit, surplus. And coming to the second part of your question, does if the bond can be liquidated as and when required like shares. So the liquidity of the bonds are relatively little lower as compared to shares, but they're still highly liquid. If you go in for a AAA rated bond or the government bonds, they are the most liquid bonds. Ms. Nanda Tirodkar from Mumbai, and she's asking the effect of interest rate on bonds.
Okay, so as I had explained earlier in one of the slides, that bond prices and interest rates, they both have an inverse relationship. whenever in a rising interest rate scenario, the bond prices will always fall because investors would always expect a higher return in an inflated environment. In an inflated environment, the earlier issues will not have as much value and the prices for those issues will fall. So to answering your question, that the effect of interest rates on bonds is that they always have an inverse relationship, and that whenever interest rates are rising, the prices of bonds will always fall.
Ankita, can we request you to take a poll here? So was this webinar helpful for you to start investing in bond market? Yes, no, or would you like to get more information? Okay, so around 75% present here says that the webinar had been helpful for them, and 25% would like to get more information on the webinar. So you can definitely reach out to us for more information. I'll just quickly share my screen once again.
So we would love all of you all if you could reach out to us through our website, which is mentioned over here. Regarding any queries, you all can always drop in a mail, and you all can always give us a call on the mentioned phone number over here. And thank you so much, everybody.
Yeah, thank you, Parutosh. And hope today's session was insightful for all of us here. And we hope we could enhance your investment journey in bonds.
Thank you, Shaili and Krish, for making the investors aware about the bond markets in India, and also for explaining them the basics of investing in bond markets in India. So on behalf of NSE, I would like to thank BondsIndia team for this insightful knowledge builder webinar. I would also like to thank the investors for participating in this webinar and making this webinar interactive through asking you questions and basically you answering them. So very soon we will come with more interesting topics on this NSE Knowledge Builder webinar. Once again, on behalf of NSE, I would like to thank everyone and wishing everyone a prosperous 2023. Thank you.
Thank you, everyone. Thank you, NSE. Thank you, all participants today. Thank you.